Let us begin with a confidential memorandum dispatched by Bank of America to its ultra-high net worth tier earlier this week. This document was not distributed to everyday retail traders. It was exclusively reserved for elite hedge funds and colossal asset managers dropping $50,000 annually for premium proprietary analytics. Having reviewed the contents, I can confirm that its granular breakdown, highlighting exact industries and precise catalysts, represents the most potent, actionable market intelligence surface since the Great Recession. The core thesis asserts that an impending regulatory rescue is imminent. When this pivot materializes, traders who have strategically aligned their portfolios beforehand will capture a decade's worth of profit within mere months. I will deconstruct Bank of America's exact guidance, detailing this impending policy shift, identifying the winning industries, and explaining why the forthcoming 30 to 60 days offer the most critical wealth-building window we will witness over the next half-decade. First, a blunt reality check regarding our premise. The current United States-Iran conflict will generate immense wealth for a select fraction of the market. Not everyone, just a calculated minority. The dividing line separating winners from losers is not raw intellect, insider networking, or raw data access. Rather, it hinges on comprehending the underlying mechanics that convert geopolitical warfare into financial advantage, and positioning oneself accordingly before the regulatory rescue triggers. Having observed numerous historical shocks, I recognize that those securing generational fortunes during crises rarely anticipate the disaster itself. Instead, they profoundly understand inevitable aftermath. Let us establish the factual baseline as of today, March 30th, 2026. We are exactly 5 weeks into Operation Epic Fury, which commenced on February 28th. The S&P 500 has retreated 7.4% from its January apex, suffering 5 straight weeks of contraction. On Friday, the Dow surrendered 793 points to finish at 45,166. The S&P 500 declined 1.67% to 6,368, while the Nasdaq Composite plummeted 2.15%. Brent crude commands $114 a barrel, with WTI eclipsing the $120 threshold. With the Strait of Hormuz firmly under Iranian blockade, the regime effectively throttles 1/5 of global petroleum and liquefied natural gas flows. Recently, 2,500 American Marines deployed to the theater, presaging a larger ground campaign to secure the waterway. Gold trades at $4,428 per ounce, plunging 21% from peak valuations, while silver has collapsed by over 40%. Meanwhile, the University of Michigan's consumer sentiment metric cratered by 5.8% to a multi-year low of 53.3, and inflation forecasts ticked upward to 3.8%. We are witnessing a universal liquidation where traditional safe havens are bleeding alongside broad equities. Consumer optimism is evaporating, prompting everyday investors to adopt one of two doomed strategies: capitulating in panic or paralyzing in indecision. Both reactions will prove catastrophic by autumn. Here is the hidden mechanism you must grasp to unlock the opportunity. Government bond yields are actively compressing despite oil surging past $120. This indicates Wall Street is currently far more terrified of an economic depression than runaway consumer prices. Prior to hostilities, yields softened as cooling inflation hinted at Federal Reserve rate reductions. The outbreak of war temporarily spiked yields as skyrocketing energy costs threatened to reignite inflation. Now, ironically, monetary easing appears probable once more. Consider the implications of this progression. Markets have transitioned from pricing an inflationary crisis, which is toxic for precious metals, fixed income, and yield-sensitive equities, to pricing a recessionary contraction, which is lethal for cyclical businesses but remarkably bullish for alternative asset classes. Bank of America analysts concluded that while crude fluctuating between $80 and $100 primarily fuels inflation and necessitates hawkish Fed policies, breaching that optimal zone alters the equation. Above $100, the economic damage becomes so severe that the threat of widespread unemployment overtakes the threat of rising prices. Translation: hyper-expensive energy suffocates the economy so rapidly that recession fears conquer inflation fears. Consequently, the central bank abandons rate hikes in favor of rate cuts. This pivot catalyzes explosive, vertical recoveries in the most heavily suppressed asset classes. This phenomenon is the aforementioned regulatory rescue, and its arrival is mathematically certain. The dossier outlines 3 distinct events capable of triggering this massive upward repricing. I am sharing this because retail traders deserve the same analytical framework as institutional whales. The first catalyst is geopolitical de-escalation, such as a formal truce, a negotiated unblocking of Hormuz, or any diplomatic victory driving crude back toward the $85 to $90 range. Washington is actively deploying strategic petroleum reserves and organizing naval convoys to protect tanker traffic. Despite conflicting political rhetoric regarding negotiations, markets will aggressively buy any legitimate sign of peace, triggering an immediate relief rally across all sectors. The second potential trigger is covert central bank easing. Given that a formal rate cut is politically toxic while inflation sits at 3.8%, the Fed will likely utilize alternative liquidity tools. Expect clandestine quantitative easing, specifically the purchase of Treasury bonds to suppress long-term interest rates without officially adjusting the baseline federal funds rate. This maneuver, utilized effectively since the 2008 meltdown, injects liquidity without forcing policymakers to admit their primary inflation strategy failed. The third catalyst is coordinated executive action, involving a sweeping package of global tariff removals, emergency fiscal stimulus, or synchronized international petroleum reserve dumps. Prominent analysts suggest the downward trend is nearing exhaustion, citing deeply oversold technical metrics like the RSI that mirror the bottom of the 2022 bear market. Any single catalyst or a combination thereof will detonate a violent, vertical rally in oversold equities. We are not anticipating a gradual stabilization. We expect a rapid, aggressive upward correction from currently extreme levels of pessimism. Crucially, even if the military conflict drags on, historical precedents dictate that markets typically establish a floor once the initial shock is fully digested. After 5 weeks, that shock is priced in. Regarding sectoral allocation, Bank of America is recommending 4 specific areas to its premium clientele, a strategy largely ignored by mainstream financial broadcasts. The first category is midstream energy infrastructure. Do not purchase upstream exploration companies, as their stock prices have already surged, making them a trap for late-arriving retail capital. The true value lies in midstream logistics, such as pipeline operators, bulk storage hubs, and LNG processing terminals. These entities function as toll roads for hydrocarbons. They secure a fixed fee for every barrel transported, remaining largely insulated from underlying commodity price volatility. Furthermore, they directly benefit from the permanent supply chain restructuring triggered by the Hormuz blockade. The second category is aerospace and defense. Morgan Stanley advocates accumulating positions in industrial resilience, national security, and defense manufacturing. This is not merely a short-term gamble on the current Middle Eastern theater. It represents a prolonged, structural reallocation of federal budgets that will persist long after a ceasefire. Recall that post-9/11, defense contractors outpaced the broader index by 47% over 5 years. The third category, battered consumer discretionary, requires contrarian courage. Leisure, hospitality, high-end retail, and dining equities have plummeted to valuation depths unseen since the pandemic and the 2008 collapse. Over half of the S&P Consumer Discretionary Index sits 20% or more below its trailing 52-week peak. Historically, when this sector experiences such extreme compression relative to the broader market, it generates an average 14% outperformance over the subsequent year, a phenomenon observed in 82% of historical occurrences. The final category encompasses next-generation software and consumer credit. In the ensuing panic, enterprise software has been indiscriminately dumped as if the artificial intelligence boom suddenly evaporated. The massive $300 billion capital expenditure commitments from tech titans will proceed irrespective of $115 oil. These software architectures are being liquidated strictly due to macro volatility, creating an incredible discount. Similarly, consumer finance institutions stand to gain massively from impending interest rate normalizations. I prefer providing a mental model over blind stock picks, so use this institutional framework to categorize potential investments. You must separate structurally damaged assets from temporarily repriced ones. Avoid entities permanently crippled by the shock, including commercial airlines suffering catastrophic fuel margin compression, cash-burning growth startups relying on non-existent cheap debt, and enterprises utterly dependent on Middle Eastern logistics networks. Conversely, target assets dragged down purely by psychological contagion. This includes domestic-facing consumer brands, software firms with zero oil dependency, and precious metals like gold, which suffered temporary algorithmic sell-offs due to central bank margin calls despite its impeccable long-term macroeconomic thesis. To navigate this, you must internalize 3 ironclad rules of crisis investing. First, never chase parabolic spikes. Energy producers and arms manufacturers have already experienced their primary upward explosion, and buying them today means absorbing the risk while the smart money takes profits. Second, monitor capital flows and ignore the news cycle. The simultaneous phenomenon of sinking bond yields and skyrocketing oil is the single most vital metric currently flashing, confirming the bond market believe a recession is imminent, and thereby guaranteeing the forthcoming Federal Reserve pivot. Third, deleverage immediately. You cannot capitalize on these generational discounts if a sudden margin call liquidates your account. If you are trading on borrowed capital, a further market dip will wipe you out right before the historic rally begins. Ensure your capital structure allows you to hold through maximum turbulence. Every catastrophic energy crisis over the past half-century has birthed unimaginable wealth for those who decoded the underlying mechanics. The 1973 embargo triggered a 2,300% decade-long explosion in gold. The 1979 shock cemented years of outperformance for defense and infrastructure, and the 2008 panic offered 500% returns for those brave enough to buy the absolute bottom. The 2026 Iranian conflict constitutes the most severe supply shock since 1973, objectively classified as the greatest disruption in the history of petroleum logistics. However, like every preceding catastrophe, it will resolve. The strait will eventually open via military force, diplomatic consensus, or Iranian economic exhaustion. Petroleum costs will normalize, and the Federal Reserve will slash interest rates, compelled either by economic stagnation or the crushing arithmetic of servicing $39 trillion in sovereign debt. The regulatory rescue is predestined. The individuals referenced in the title of this analysis are those allocating capital right now, anticipating the pivot. Those waiting idly for absolute geopolitical clarity will only read about the massive gains in hindsight. Yes, we may face further short-term downside, but pinpointing the absolute market floor is impossible. What is vital is establishing your positions in temporarily distressed, high-quality assets before the liquidity floodgates open. The ensuing surge will be violent and highly lucrative for the early actors, and confirmation of the recovery will only be obvious after the profits have been captured. Monitor currency strength, track bond movements, and prepare your portfolio for the pivot. because the current conflict will mint new fortunes, and you must ensure you understand the mechanics to be among them.